This chapter, cash and receivables, so interesting chapter that looks at how we account for cash, account receivable, note receivable. So in this chapter, we'll look at how we report cash, the balance sheet, some summary of cash-related items and cash equivalents. We'll look at receivables, when they should be recognized, and their valuation, and take into account, of course, the allowance for doubtful accounts. We'll look a little bit at notes receivable. Sometimes we'll have to have a note receivable from a customer who cannot pay their account receivable. So we'll say, hey, okay, pay it in 90 days, but there's going to be interest. And then some special issues related to receivables and cash. So what is cash? It's, of course, our most liquid asset that we use to pay all of our bills, right, and receive cash so that we can pay those bills. Standard medium of exchange, at least so far. Of course, we know about Bitcoin, and that might, along with blockchain, that might change things as far as most liquid asset. It's a basis for measuring and accounting for all items. So everything in the financials, right, is based on cash. It's not cash-based, it's accrual-based, but everything is in terms of dollars. It is a current asset, so and here's some examples: coin, currency, available funds on deposit at the bank, money orders, so forth. So reporting cash and cash equivalents. So cash equivalents are short-term, highly liquid investments that are readily available to convert to cash, and they're very close to maturity, so they really present no risk to us. Treasury bills, commercial paper, and money market funds are so funds from the government. Those are all considered. Government types of transactions, government investments, and they're considered cash equivalents. All right, restricted cash, and that means that we have cash available, but another company is restricting it. So, for instance, we might decide we're going to expand our plant, or we're going to retire some long-term debt, or we might have a line of credit in a bank, and they require a compensating balance. So that's a minimum that must be maintained in a bank account. So we might have a line of credit up to $5,000 a month with a bank, but they're saying, hey, if you're going to do this, we also want you to keep $5,000 or $2,500 in our account. This is a bad situation, right? We have a bank overdraft. We write a check for more than the amount in the cash account. That would be, first of all, it's against the law, so it's something we should not be doing. Generally, they'll be reported as a current liability, and we can only offset that against other cash accounts if we have accounts in the same bank. So if I drew the bank check on Bank of Bolivar, but I have a savings account there, then I can offset it. My company does, and I can offset that cash account. And I can offset it against that particular savings account. All right, this is the classification of cash and cash equivalents and non-cash items. So cash, of course, is reported as cash. There are some issues, though, on disclosures that if it's unrestricted, we just report it as cash. But if it's restricted, we identify it, and part of it might be non-current because we're not going to use it for over a year. All right, petty cash is just reported as cash. Short-term paper, we talked about this earlier, like U.S. Treasury bills, would be a cash equivalent. Normally they have a short time to maturity, so there's really little risk involved with that type of instrument. Short-term paper, temporary investments, these have a maturity of 3 to 12 months, so more than likely they'll be reported as a current asset. Post-dated checks, so we can't, of course, cash post-dated check in IOUs. Those are considered receivables and assume that we can collect those. Travel advances, maybe from our salespeople, would be a receivable. Postage on hand, as stamps or in postage meters, would be a prepaid expense. Bank overdrafts would be a current liability. Compensating balances is cash, but we do need to record it separately as a deposit and note, disclose it, that in the financials and the notes of the financials that we do have a compensating balance, and we would need to note the amounts. All right, so that's everything you need to know about cash. Receivables are claims held against customers and others for money, goods, or services, right? So an account receivable, you know what that is. We sell a product to a customer, we deliver the product, and they promise to pay in 30 days. So it's oral promise. It is, of course, a legal document. So it's a legal contract, even though it's oral, that we promise to pay for goods and services. And then it could also be, if it's a note receivable, it's a written promise. So a note receivable might arise if we have an AR, net 30 is our policy. However, someone's going to be late. They're going to be, say, 60 days late. So that's fine. You write us a note. We'll set up a note receivable between us and you can pay us in 60 days, but there's going to be an interest charge. All right. Non-trade receivables, these are outside sort of the normal course of business. So advances to officers and employees. Okay, so say a paycheck advance to an employee or an officer would be a non-trade receivable. Advances to subsidiaries, and they may not be wholly owned. Deposits paid to cover potential damages or losses. Deposits paid to us for potential, like for an apartment complex, if a pet deposit would be an example of that there might be, right, some issues with the carpeting and so forth. So you say, okay, $500 deposit, that would be a non-trade receivable. Deposit paid as a guarantee of performance or payment. So we will do this work, but we want you to pay a $500, we'll put a new floor in for you, but we want $500 up front first. Dividends and interest receivable would be a non-trade. Those are non-trade receivables. And then any claims that we have against insurance companies for casualty. So as a casualty, our roof fell off. They owe us $5,000. That's a non-trade receivable. If someone else, a defendant in a suit, we're suing somebody, we expect to win, that would be a non-trade receivable. All right, recognition of accounts receivable. Generally, as part of revenue, right? We sell a product, they promise to pay 30 days later. Revenue recognition principle indicates that a company should recognize revenue when it satisfies its performance obligation by transferring the good or service to the customer. So if there's an exchange that's taken place, we've sent goods or services to the customer, they have promised to pay, that's the exchange. So for example, if Lululemon sells a yoga outfit to Jennifer Berean for $100 on account, the yoga outfit is transferred when Jennifer obtains control of this outfit. So she buys the outfit, comes in the mail, now she has control of it. When this change in control occurs, Lululemon should recognize an account receivable and sales revenue. So there's your entry. Pretty standard entry that you're well familiar with, debit account receivable, credit sales. So some key things, though, Lululemon has the right to payment from the customer. So they have the product, so we have the right to get payment. Lululemon has passed legal title to the customer. Again, if they have the product, then legal title normally is passed. Lululemon has transferred physical possession of the goods. She's wearing the yoga suit, right? Lululemon no longer has significant risks and rewards of ownership of the goods, okay, because we don't have control of the goods. And Jennifer has accepted the asset. So that means we've created an account receivable, and we can make the entry on the previous slide. All right, recognition of accounts receivable, measurement of the transaction price, so that's the amount of consideration the company expects to receive from the customer. Variable consideration, in some cases, the price of a good might be dependent on future events. So there may be a discount, there may be a return on allowance, there may be a rebate, there may be a bonus. So we'd have to take that into consideration when determining the transaction price. A common consideration is offering cash discounts to customers. These are in terms such as 210 and 30, which means 2% discount if pay in 10 days, otherwise net is due in 30 days. 210, 2% discount if pay within 10 days, or EOM. EOM means pay by the end of the month. And then there's gross method versus net method, which I can show you on the next slide. So over here on the left, we have the gross method, which is probably what you're most familiar with. We debit $10,000 to account receivable and credit sales revenue for $10,000 for a $10,000 sale. Terms are 210 and 30. So we're assuming at least on 4,000 of the sales, they're going to take the discount. So 2% of 4,000 is 80. They're paying us $39.20. So I record the discount for 80. Cash is debited for $39.20, and AR is reduced by 4,000. The other 6,000 is outside the discount period, so we debit cash and credit account receivable for 6,000. Net method is that we assume we'll take the whole discount. So a debit account receivable credit sales revenue for $9,800. So 2% of the discount was $200, right? So hey, we're assuming under net method, we're taking the whole discount. So then when the $4,000 is presented, when the customer pays us $4,000, we debit cash for $39.20 and credit account receivable for $39.20. All right, but then $6,000 received after the discount period. So we have a sales discounted lost account of $120. We'll credit that, and we'll debit account receivable for $120, and then we'll debit cash for $6,000 and credit account receivable for $6,000. Okay, so if you're the purchaser, we'll talk about this in the inventory chapter, but the discounts lost account is nice. It's a performance evaluation. It shows you how much you could have taken, but you didn't. Now, this is from the sales side. So we're more than happy for them to forfeit the sales discount as long as they pay their balance. All right, recognition of AR, sales returns and allowances. So sales returns and allowances is a contra account, which means it has a debit balance. Right? It's a contra account to sales revenue. Now, there's a difference, by the way, between sales returns and allowances. Sales returns is when you physically return the goods back to the shop, so back to us. Allowances, though, will tell them you don't need to, maybe if it's a case of wine that was destroyed in transit or what have you, or it was dropped, and it's our fault. So okay, we'll just give you an allowance for that case of wine, but you don't have to return all the broken glass. All right, so sales returns allowance, contra account to sales revenue. The allowance for sales returns and allowances is contra account to accounts receivable. So the use of these accounts is helpful in finding problems with inferior merchandise, inefficiencies in filling orders or delivery mistakes. So these accounts basically can serve as performance measurement. These accounts are high, and we have a lot of sales returns, and we have a high allowance for sales returns because we have a lot of sales returns. That's problematic, and we need to find ways to process our product better so we don't have this issue going forward. Time value of money. Any revenue after the period sale is interest revenue. So I talked about that earlier, that you may have a note receivable because they weren't able to pay in 30 days. So anything after that is going to be considered interest revenue. But companies usually ignore this interest revenue related to AR because the amount of the discount is not material in relation to net income for the period. So it's immaterial. So it's normally ignored. However, the FASB has stated receivables arising from transactions with customers in the normal course of business, which are due in customary trade terms not exceeding approximately 1 year. So excludes from present value anything that's less than 1 year. So it's less than 1 year, they don't want to see any present value calculations on these account receivable transactions. All right, so valuation of account receivable involves both the classification and valuation of the balance sheet. So classification determines the length of time the receivable will be outstanding. It should be 3 months, 3 months, 6 weeks, that sort of thing. Value and report short-term receivables we value and report short-term receivables at what we call net realizable value, which would be the sales amount less the amount we typically expect that we will not collect, so the allowance for doubtful accounts. All right, so uncollectible accounts receivables, credit losses can be recorded as a debit to bad debt expense. Now, I'll warn you on this, bad debt expense should only be debited if you use the direct write-off method if you are not a publicly held company, because the direct write-off method, which is shown down here, the direct write-off method is not GAAP. All right, so GAAP requires you to use an allowance account. There's a couple different ways they allow you to do it, but you must use an allowance account for GAAP. All right, so we'll record losses as bad debt expense, but normally we'll debit uncollectible accounts expense and credit the allowance account. normal and necessary risk of doing business on credit, two methods, direct write-off method and allowance method. So let's look at each of these. So the direct write-off method is sort of theoretically deficient. There's no matching. We're not matching up revenues with expenses. It might be 2 years after the sale that we write the thing off. Receivables are not stated at cash realizable value because we're not using an allowance account. It's not GAAP. If it's material in amount, it's not GAAP, and normally these amounts 2 or 3% of sales in aggregate. That's in aggregate. So not GAAP, in aggregate, if it's material. So bad debt expense could typically be 2%, 3% of total sales. So normally the auditors are going to consider it material. The allowance method, which is GAAP, is where we estimate our losses using either percentage of sales or percentage of receivables. All right, so the direct write-off method, we just debit bad debt expense and credit accounts receivable. So at $8,000 write-off, debit bad debts, expense, credit, receivables. Again, not GAAP unless your bad debts are immaterial for the year or you're not a publicly held company where you don't need to use GAAP. Okay, let's look at the allowance method. So the write-off method is pretty easy, just debit bad debt expense, credit AR. And probably make a note not to sell on credit to the USADA company anymore. All right, so the allowance method involves finding that uncollectible amount at the end of the year, ensures us that we're going to have our receivables on the balance sheet, net realizable value. Companies estimate the uncollectible account and net realizable value using information on past and current events as well as forecasts of future collectibility. All right, so normally the allowance method using classification, looking at classification of your bad debts, how much past due they are. There you're looking at really past information. The sales method, though, the percentage of sales method, I think you're using more future information when using that approach. All right, so assume that Brown Furniture has credit sales of $1,800. Of that amount, $150,000 is uncollectible. Credit manager estimates that $10,000 of these sales will be uncollectible. So there's $150,000 that's not collected December 31st, but we estimate that $140,000 will be collected. We estimate the other $10,000 will not. So we go ahead and make an entry to the allowance account where we debit bad debt expense and credit the allowance account for $10,000 to take care of that $10,000 that will not be collected on these $150,000 of sales. All right, so right off of an uncollectible account, so if you exhausted, you sent them letters, you got a collection agency, all this stuff, they're not going to pay, possibly bankrupt, we should write the account off. So in the credit card industry, if you're wondering how long it takes them to write an account off, 210 days past due is normally, so probably 240 days since point of sale. So 240 days, almost 2/3 of a year, I guess, before they write it off. All right, so here's the write-off using the allowance method. We're going to write off $1,000 to Randall, so we debit the allowance for doubtful accounts, credit account receivable. Notice that we already recorded the bad debt expense in the adjusting entry on December 31st. Assume that on July 1st, Randall pays the $1,000 amount that had been written off. So here's the entry. So we go ahead and reverse this entry out here and debit AR and credit allowance, and then we'll debit cash and credit account receivable, and all is hunky-dory with Randall Company, who took about a year probably to pay their bill. Okay, so that's the valuation of accounts receivable using the allowance method. Percentage of receivables approach is where we look at our sales. So we use one rate, percentage of receivables approach, report amount, estimate receivables at realizable value. Companies may apply two approaches, the one composite rate or an aging schedule. So the one composite rate is used for percentage of sales method. So that's what this one is percentage of sales method. And then the second one would be the aging approach. So this is using the aging approach. It's more of a balance sheet approach. Probably gives you a better balance sheet number than sales number or income statement number. So we have 4 customers that are past due. Western, Brockway, Freeport, and Allegheny. And so, of course, the more they're past due in days, probably the higher risk they're not going to pay. So, for instance, this Freeport sheet and tube work, they're over 120 days past due of $55,000. So, chances of seeing that money might be slim. So, under 30 days is fine. That's current. 30 to 60 days, that may be current or may not. Usually 30 days is current, so that's probably not current, but not by much. 18, 14, and 56. So of 345, we estimate that most of this is going to be collected. So our experts using data analytics have found that the required balance, 2760. 0.8 times 345 is all we need in the allowance for this. Higher risk for the 115, right, 4%. It's 4,600. 60 to 90 days, 15%, 2,700. And then this last one we talked about earlier, about a 25% chance we're not going to see that, so we'll put 13,750 for that. So there's our balance in that allowance account, 26,610, using the balance sheet method, aging of accounts receivable. The other approach to use would be your sales. So if your sales are $1 million, I think 1% are going to be uncollectible. 1 million times 1% is what, 10,000. So we would debit the allowance account for 10,000 and credit, and debit bad debt expense for 10,000 and credit the allowance account for 10,000. Same thing here. You would debit the allowance account for credit the allowance account for 2610, debit bad debt expense for 2610. A note receivable. Written promise to pay a certain sum of money at a specific future date. It's a negotiable instrument. Maker signs in favor of a payee. It is interest-bearing, normally interest-bearing, but it could be zero interest-bearing. If it's zero interest-bearing, basically interest will be included in the face amount. It's a little trick. It really is interest-bearing, but the interest is in the face amount of that note. So generally, the note receivable from customers who need to extend payment on outstanding receivable, high risk, your new customers, loans to employees and subsidiaries, sale of property, plant, and equipment, and it's expensive, so they can't really afford to pay us cash, they're going to give us a note, and then your lending transactions, which is probably the majority of notes, lending money to customers that can't pay their bills, so say, okay, you can pay it in 3 months, and you're going to have to pay as interest. All right, so recognition notes receivable. Short-term should be recorded at face value, less any allowance. Long-term should be recorded at present value of the cash to be, so we'll show both these. All right, so here's a zero interest-bearing note. So Jeremiah receives a 3-year, $10,000 interest-bearing note. Market value is 9%. So what we're saying is the interest is located within this 10,000. How does Jeremiah record the receipt of the note? All right, so first of all, we want to find what the present value of that note is. So they gave us 10,000. All right, so the 10,000 is not going to be paid for 3 months. So we'll use the interest rate is 9%. All right, so the factor then is 0.7728. So we use the present value of a dollar table, and that's for one payment, right? So we find the net present value of this one payment, and $7,721.80. Okay, so that's the principal part of the note. That's present value of the note. Okay, and then we're going to use that 9% to compute our interest revenue. So carrying amount of the note is $77.21. And then we have interest revenue for the first year of $77.21 times 9%, right, the market rate of interest. Discount, remember before we had some, in the bond problem, they actually did have some cash here. But there's no cash here, so the discount or amortized is going to be the same as the 9% interest revenue. So you notice when you add those three amounts up, $22.78 and 20 cents, adds up to 10,000. So the face value of the note is 10,000, probably the amount they owe us is $77.28, $77.21. The rest of that is interest. So we use the present value calculations to determine how much is interest in that note and how much is principal. All right, so then here's the entry at the beginning of the note, that the note receivable is $10,000, discount, which is your interest, is $22.78, and then the cash we're going to give them is $77.21.80, but they're going to have to pay us back $10,000. All right, and so the journal entry in the first year, we collect interest revenue of $694, and we'll debit discount on notes receivable for $694.96. Notice that we don't debit interest revenue, because we got interest revenue down here. So we have to debit it to something. So the discount receivables, and that shows that the carrying value of the note increased. What the discount shows is the carrying value of the note increased from $77.21 to $84.16. An interest-bearing note. In this case, we have a 3-year loan to Marie Company. Morgan Company makes a loan to Marie Company for $10,000, 3-year note. 10% 10% interest face value, but the market rate at the time is 12%. So we're going to use that 12% to find the present value of that interest. So we take $1,000, multiply it by 2.401, it's $1,000 for 3 periods. So the present value of the $3,000 is $24.02. Then the note, we're also going to have to find the present value of that. So we use a 12%, 3 periods, factor is 0.7118. We multiply that by the principal of $10,000, we get $71.18 as our present value. All right, so the fair value of the note is $10,000. Present value of the principal is $71.18. Present value of the interest is $24.02. So the discount on this note is $480, difference between $10,000 and $95.20. So $95.20 is the present value of our principal and interest. $10,000 is the fair value of the note. So our entry to pay the customer is discounted amount. We debit notes receivable for $10,000. Our discount is $480, and the cash is $95.20. Now the discount's a lot smaller here because this $10,000 includes some of the interest, right? We'll see this in a minute, but it's an interest-bearing note, not non-interest-bearing. So the $10,000 does not. I'm sorry, the $10,000 does not include the interest, where in the other one it did. So the interest is not included in this $10,000. It's outside. So the $10,000 basically is just your principal, $95.20, I guess. Really, since we discounted back 3 years, that's your principal. All right, so let's take a look at some of these entries. So we received $1,000 each month. So that's above and beyond the $10,000 they're going to pay us back on the principal. So our interest revenue is $11.42, which is the $95.20. All right, carrying value of the note times 12%, so $11.42 is our interest. We did have cash received of $1,000, so discount is $142. So notice the discount's a lot smaller because the amount within the note for interest is a lot smaller on this. It's just $480, where the other one it was $2,300. All right, so we go ahead and make our entry. We debited cash for $1,000, credit interest revenue for $11.42. The difference is discount. Recognition notes receivable. So notes received for in a bargain transaction, arm's length, stated interest rate is presumed to be fair unless no rate is stated. Stated rate's unreasonable. Face amount of the note is different from the current cash price. So we'd want to, these things would most likely, if the material would have to be disclosed that the interest rate is lower than it should be. Fair amount of the note is materially different than current cash sales price. So those things would need to be disclosed in your notes. Valuation notes, so short term should be reported at net realizable value, so same thing for accounts receivable, so less anything you don't expect to collect. And then long term, FASB requires companies to disclose not only their costs, but their fair value of the notes in their financials. All right, some fair value options. You do have the option to use fair value in measuring your notes. Company uses fair value. Receivables must be recorded at fair value. Unrealized holding gains or losses are reported as part of net income. All right, and then company reports the receivables at fair value at each reporting date. All right, so that's all I have on notes. So a couple more special things. But I'm sorry, this is not really IFRS. This is in congruence. The fair value option, though, is in congruence with IFRS. All right, so companies may elect at the time of the financial instrument is recognized or when some event triggers a new basis of accounting, you can go ahead and elect the fair value option. Usually you elect it at the beginning. You must continue to use the fair value. Once you select it, you must continue using it until you no longer own the instrument, until it's been paid off. If not elected at date of recognition, company may never use fair value on that specific instrument unless there was some special event that triggered a new basis of accounting. Very rare. So normally, once you don't do it, you have to say at the very beginning when you receive the note receivable in your possession, at that time say, okay, we're going to record this at fair value. Otherwise, it cannot be. Disposition of the accounts and notes receivable. So owner may transfer their account and notes receivable to another company for cash. May need some cash crunch, competition, right? Need to gear up and make more inventory. Money is tight. Building collection you think are time consuming, let someone else do it. So transfer can be accomplished by one of two ways: secured borrowing or sale of receivables. So let's look at sale of receivables first. It's calling factor receivables. So the customer places an order, requests a company, then goes out, go ahead and accept the order. Request a credit review. We go ahead and approve the credit. Advance cash back to the company. Ship goods to the customer. And then the customer makes payment, but to the factor account. So what happens is they go ahead and place an order with us, and we say, hey, we don't really want this receivable. We want you to take care of it, the factoring company. So you take care of it. And so they may request a credit review, and they may do a credit review on us and a credit review on that customer. They say yes, they approve it, then they'll advance cash to us, and then they'll collect the receivable. We'll ship the goods, and then they'll make the payment, but not to us, but to the factoring company. So we can do this without recourse or with recourse. If it's without recourse, then the purchaser is assuming risk of collection. So the factor company transfers outright sale of receivable. Seller records loss on the sale. Sale with recourse, seller guarantees payment. Purchaser financial components approach is used to record the transfer. So let's take an illustration. So Crest Textiles factors or sells $500,000 of receivables to commercial factors on a without recourse basis. So commercial factors assesses a finance charge 3% of the amount of receivables and then retains 5% for adjustments like for a bad debt. Crest Textiles and commercial factors makes the following journal entries for the receivables transferred without recourse. All right, so Crest Textiles will debit $460,000. That's cash they're getting from the factor company. $25,000 is at 5% for bad debt expense and other adjustments like sales returns. The $15,000 is the loss on receivables. So the finance charge of 3% times $500,000. So the $15,000 is a loss on those receivables. All right, and then the note receivable or account receivable is credited for $500,000. So we no longer really have ownership of the receivables. Notice they are the $15,000 is being retained by commercial, and so they're going to take care of if there's bad debts or sales return and so forth. I'll do that. All right, then commercial factors will debit receivables for 500,000, credit due to customers for 25,000 for those adjustments, interest revenue 15,000, then credit cash for 460. All right, here's an illustration of secured borrowing. Howitt Mills provides 700,000 of its receivables to Citizen Bank as collateral for a 500,000 note. Howitt Mills continues to collect a receivable. The account debtors are not notified of the arrangement. Citizen Bank assesses a finance charge of 1% of the receivables and interest on the note 12%. Howitt Mills makes monthly payments to the bank for all cash it collects on the receivables. All right, so on this one, the secured borrowing, notice that basically Howitt Mills is doing some of the milk, but it's doing some of the work, but they're assigning these receivables to Citizen Bank. So Citizen Bank is taking a risk on whether those receivables will be collected. So they do ask for, in this case, they're issuing a $500,000 note. So the $700,000 receivable is basically they're assigned to Citizen Bank, so they have ownership of them. As long as Howitt Mills pays their bill to Citizens Bank for the $500,000 note, everything's fine. If not, they're going to collect, the receivables have been signed to them, so they'll be legally able to collect these receivables from Howitt Mills. So here's an example of it. April 1, Receipt Company assigns $400,000 of its accounts receivable to Third Bank because of a $200,000 loan due on July 1, 2017. So this means if they don't pay the $200,000, the bank can collect from this $400,000 AR. The assignment agreement calls for Rashid to continue to collect the receivables. The Third National Bank assesses a finance charge of 2% receivable and interest on the loan is 10%. So prepare the three entries. Journal entry for Rashid and Company for the $200,000 note. So we debit cash for $192. There was a finance charge of 2%, so debit finance charge for $8,000, and then we credit notes payable for $200,000. All right. Then Rashid collected $350,000 of AR, so debit cash, credit AR. Then we paid the note payable off. $200,000 was the principal, and then I think they told you there was a 5%. There was a 5% charge. Interest on it is 10%, excuse me, 10% charge on the note times 200,000, so that's 20,000, and then it's for only 3 months. So 25% of 20,000 would be 5,000, and then credit cash for 205. Secured borrowing versus fail. So FASB has concluded that a sale only occurs if the seller surrenders control of the receivables to the buyer. And so these conditions must be met. 3 conditions must be met. Transferred assets must be isolated from the transferor. Transferee has right to pledge or sell the assets. Transfer does not maintain control through a repurchase agreement. Presentation of receivables. So separate the different types of receivables that a company possesses. Note receivable, account receivable, so forth. Offset the evaluation accounts against proper receivable accounts, if you have those. Determine that receivables classified in the current year will be converted into cash or operating cycle, whichever is longer. So in other words, it has to be a current asset. The receivables, we must determine that they're current, so they're going to be paid off within the year or operating cycle. Disclose any loss contingencies that exist on the receivables, so maybe a lawsuit or something related to those, and we need to disclose that in our notes. Disclose any receivables designated or pledged as collateral, and then disclose any credit risk inherent in the receivables. Next, AR turnover ratio is a performance evaluation we can use to look at how well we're collecting our receivables. Sales divided by net receivables, so beginning of the year, end of the year divided by 2. So it looks like the turnover is every 11 days, which I think was probably pretty good. So the shorter that turnover is, the better that indicator is. All right, that's all I have for you. I will have a quiz up for chapter 6 probably tonight, tomorrow morning. So take a look at that. And for present value, study your concepts, work through your problems, work through the Wiley Plus. There'll be an extra credit problem quiz for the chapter 6 and probably something similar for chapter 7 as well. All right, have a good night. Have a good week. Appreciate your attention.